Jeff, it's a pleasure having you on my podcast. And I know we're going to get deep in the weeds on your book and your thoughts on the private equity and LBO industry in a little bit. But for our listeners, I'd love for you to walk us through your history and really how you've gotten to where you are today. I know you spent some time on the investment banking side early in your career, but if you'd give us that window and picture into your past, I think that'd be a great lead into how you got to the point where you wrote this book.
I started my career after grad school in New York City. So I worked in several Wall Street jobs as an investment banker or private investor. After leaving Wall Street, I came down to Washington, D.C. I worked in international finance for the World Bank, doing deals in Latin America. I then shifted to a gigantic private equity fund where I was closing transactions in Asia, even though the fund had operations in Latin America and Eastern Europe as well. So that would be the emerging markets. Along the way, I wrote several books on finance, mergers and acquisitions, security analysis, emerging markets. After my spell at the international private equity firm, I reverted back to investment banking, doing deals. So I spent another dozen years as an investment banker in the Washington, D.C. area. As I got a little older, I wanted to cut back my travel schedule. I thought having an interest in writing books, and I had taught some classes at night, I decided to pursue a job in academia. So I've been a finance professor at Johns Hopkins Carey Business School for the last 4 years. And part of the job of finance professor, and I'm sure a lot of your listeners have taken finance courses at grad school, part of the job of the finance professor, of course, is to teach students. The other part is if you're so inclined to do some research papers. So I did some research papers on pension fund management and private equity with a colleague, and that sort of stimulated my interest in how private equity performs as an asset class. And my practical experience, along with the academic experience, led me into writing this book.
Maybe before we go into the book, and I'm going to keep probably doing this, but tell me a little bit about the classes that you teach at Johns Hopkins, number of students you touch on an annual basis.
Johns Hopkins, as many of your listeners know, is renowned as an undergraduate institution. It's been around for over 100 years, and it has a huge exposure to the medical world. It's very well known around the world for its medical school. But the business school at Johns Hopkins is quite large. It's got over 1,000 full-time students. That's sort of a little-known fact. And the classes I teach at the graduate school are mergers and acquisitions, corporate finance, and project finance. All three subjects I've had a lot of practical job exposure to. So a lot of the students appreciate that, having someone with a lot of practical deal closing background.
And I will share with the listeners that if you're a student, or like I have had a couple of kids go through college, I looked up Jeff on Rate My Teacher, and he rated very well. So that's going to make you feel good. It's a very easygoing and nice teacher. I had some folks that, made some comments that you were a very tough grader, but I'm not sure that's a bad thing to prepare people to go into the real world at some point. Let's talk about your book. Maybe give the premise of it, an overarching theme, and then we can dive into some of the topics.
The premise of the book is that private equity, specifically the leveraged buyout business, which is about 2/3 of private equity, is not the greatest thing in the investment world since sliced bread. I mean, that's really the fundamental premise of this book, that what you've been hearing about private equity is a lot of exaggerations and misinformation. The business itself does not outperform a simple public index of stocks like the S&P 500 or the Russell 3000. So for a lot of your listeners who may be in blissful ignorance about the private equity business, this is going to be an eye-opener.
It's probably to a lot of my listeners and friends in the industry, they probably won't like this book very much. And clearly in any industry, whether it's the insurance industry I'm in or real estate or private equity, there's clearly your top quartile or even the higher level performing funds. How does that world look? Clearly in any industry, you're going to have the mediocrity that is pulling the group down. So how does that weigh into your view on the industry?
Well, let's first start off, as I mentioned earlier, the entire industry, if you aggregate it, Jeff, does not beat the S&P 500, despite their much publicized claims to the contrary, and to what you see in the news media that all these private equity titans are investment geniuses. Simply not true. Now, you're right. There are a small minority of funds that do beat the S&P 500, and that's the famous top quartile or top 25% that you mentioned. And they do. They beat it. They beat it by several percentage points a year. However, they cannot repeat that performance. So the data shows that the top quartile for, let's say, they're running a fund 5, so they have some success and they open fund 6. A lot of people say, well, fund 5 was in the top quartile. I guess fund 6 is going to be the same. The problem is that the chances of fund 6 landing in the top 25% are exactly 25%. So the returns, whether it's a big name fund that you've heard of or some small no-name fund, are random. There's no what they call in the business consistency, which is something that surprised me quite a bit when I was doing my research. I thought, well, if people are piling money into these big names, they must be doing better than average. But no, it's a random selection type of event. You could throw darts at a dartboard with LBO fund names and you do just as well as if you tried a somewhat rational approach or approach based on historical record.
Well, that's what I was going to ask you. As an LP or an investor in any of these funds, whether it's the large LBO funds or new funds, is there any way to have any predictability, or is it truly what you said, throwing darts at a board?
Your typical limited partner, and for the audience that's not familiar with these terms, we have so much vernacular in the Wall Street business. So the limited partner would be the investor, which would often, in a big private equity fund or LBO fund, would often be a state pension fund or a university endowment, sometimes a large foundation like the Ford Foundation. So the LPs or the limited partners, when they decide, oh, I'm going to invest in a private equity fund, they're going to approach it in 2 ways. One, they're going to look at the historical track record of the previous fund, and then they're going to assume that the next fund is going to duplicate that success. As I mentioned a couple of seconds ago, that's not the case if you look at it in a rational, scientific manner. It doesn't happen. So then the LP might say, oh, well, I can't do it on a historical basis, so I'm just going to pick a big name, like Goldman Sachs or Kohlberg, Kravis, Roberts, or something like that. And that's the safe way. It's sort of like in the computer business. How do you avoid getting fired? You always buy IBM computers. That was the big name. Well, that's the same way the LPs figured out. Well, if I just put my money into a big name, even if the fund craters, I'm not going to get canned, because I can just say, well, look, this is a very prestigious name. I went in there and so did so many others. You can't go wrong from a career standpoint, but from the investment standpoint, the big names, like I said, cannot repeat performance, and neither can the no names, neither can the top quartile. So it's a real quandary for limited partners that want to try to beat the S&P 500 index by going to private equity.
And your fund managers, which maybe it'd be interesting for you to give a little background on what their allocation systems are. They have a certain amount of capital that they allocate to more risky investments, which this would be. Can you talk about how they typically approach that world and what's typically earmarked to invest in LBO and private equity funds?
Let's just go back into time for the benefit of your listeners. So 20 or 25 years ago, most of your big institutions, most of these state pension funds or university endowments or pension plans, most of them strictly invested in publicly traded stocks and bonds. I mean, they might have a small sliver of real estate or commodities or hedge funds, but it was a very small percentage. Then private equity had a nice run in the 90s, early 2000s, and so money started piling into private equity. There was some drawback in the returns in public stocks. So pension funds went into hedge funds as well, who didn't deliver, promised stock market returns with little risk. So you have these huge promises made by the alternative investment industry, and the institutions jumped in hook, line, and sinker. So now alternative investments, which I mean private real estate, private equity, commodities, hedge funds, about 30% of a big institutional portfolio. Of course, the other 70% would be publicly traded instruments, stocks and bonds, things like that.
So you really do. And I've been in this industry for 30 years, and you see large LBO funds, private equity funds having a better than average return, top quartile, next fund being low, then the next fund being upper quartile. And so I can understand how it's hard to predict that success.
The phenomenon for us experienced weather-beaten Wall Street types is called reversion to the mean. So that means anyone in the investment management business that has a couple of good years, inevitably they're going to have a couple of bad years. So you average it over 4 or 5 years and they're hitting the average. This is the attraction of index funds. They don't require such large fees for the active managers who are picking stocks, bonds, or private companies. And the index funds inevitably do better than actively managed funds simply because of the fees. You also see the phenomenon at the institutional level, as we sort of hinted at earlier, where the large institutions, be they pension funds or endowments, virtually none of them beat a 60-40 passive index, which is 60 stocks and 40% bonds. And I find that statistic incredible, but it's true. It can be verified very easily.
As a listener thinking about how they might be taking this info, it's probably info that they don't want to hear. How many other folks in the media or other professors have a similar view in the marketplace? And if there aren't any, why is that the case? It just seems like if this was information that was easy to analyze like you have, why isn't this more a common thought?
Well, now you're getting to the theme of why has this myth been perpetuated for so many years. So let's look at academia for a second, since I'm a proud card-carrying member of a university faculty. When the private equity performance was first analyzed, say 15 years ago, it did do better than the public stock market. So a lot of the studies that were and are still cited by people in the industry or maybe some other academicians looked at performance in the 90s and early 2000s. And yes, at that point, the private equity business was doing very well, specifically the leveraged buyout business. But what happens on Wall Street, as you may recognize from your own experience, is that once a sector does well, investors pile into the sector. So they start throwing money at it, thinking that past performance will be repeated. In this case, huge sums of money went into private equity. Prices for deals increased accordingly. And over the last 10 or 15 years, the high prices paid for deals and then the high fees both conspired to drive down returns to the investors.
So with all the capital coming into the marketplace, into the pension funds, all the endowments, all the investors, the LPs, all the lenders trying to put money into deals, private equity groups that have exploded. Back when I started 30 years ago, it wasn't even an industry. And now there's a private equity group on every corner. How do you even manage this giant pool of investment money to generate a return for your limited partners?
Well, let's look at why these funds have multiplied so often, and despite what I believe are the facts. First, the reporting statistics show most don't beat the market, but even those statistics lack about 40% of the funds. So you have the data only has 60% of the funds. So you got to wonder, are the other 40% outperforming or not? I don't think they are. If they were outperforming, wouldn't they tell the world about it? So you have a lot of non-reporting funds. You also got to remember, Jeff, that about 60% of all deals done over the last 10 or 11 years have not been sold. So if the inventory is so terrific that all these funds carry, how come they can't sell it? I mean, what's the matter with it? They can't get a good price for it. So you have a lot of funds in this space buying companies that they can't seem to sell. So like it's the saying in the M&A business, it's easy to buy, it's much tougher to sell. So statistics on performance may be overdone. They may be doing far worse than even the statistics I've quoted in the book show. Now you might say, well, why isn't the media picked up on this? Well, the media is sort of an enabler. It's not that they want to promote the business, but to dig into the statistics, to dig into this information that the book goes over, you got to be a finance expert. A lot of people in the media wouldn't have the knowledge or the expertise to kind of dig in and rummage around the numbers. That's okay. You know, I understand that it's very tough to do that. The other issue is that a lot of the information is secret. You know, a lot of the information in the state pension funds, endowments is secret. They won't tell you what the fees are. They don't tell you what the underlying companies are worth. And then for the pay services that generate a lot of the return data, they would have more information you could get, say, from a public pension fund. Those are paywalled. So just to crack into the database is $10,000. And then you need a Sherpa to guide you through because the statistics are so complicated. So the media, in effect, is, which often says how great these people are and gets them on radio and TV, and they get to say how terrific their returns are, is unwitting partner to the funds. And then there's the government as well, which does not really oversee or regulate these funds' claims in any rational manner.
I would expect everything's a point in time of reporting. And so these funds typically have a 10-year lifespan. So I would assume that has something to do with it as well, where you really don't know the fund performance until it's ticked and tied and closed.
You're absolutely right. I mean, that's the definitive number when the whole fund has been liquidated. But as I said, you really don't have any definitive numbers for the last 10 years because most of their investments have not been liquidated. As an investor or as a limited partner, you're relying on what they tell you the investments are worth. Now, there is some mild oversight by, say, the auditing firm or something, but of course, they're being paid by the fund, so you got to wonder. But you're relying on what they tell you, which I don't think is the best way to run an investment business if I was a limited partners. I liken the whole process of a fund grading or marking its own investments value to an 8-year-old grading her own homework. If you were a teacher, you wouldn't let the students grade their own homework, would you? Everybody would get an A. Yet here you've got a multi-trillion-dollar industry, which on a year-to-year basis, when the investments aren't sold, gets to tell their own limited partners what the investments are worth. I think the whole situation is quite bizarre, but it's been in place for 2 decades.
So I'm interested in your answer to this question. You teach students who have an aspiration to go into private equity and investment banking in the LBO world, and yet it seems like it's probably not as sexy as it might sound. What do you tell your students?
When I say talk to my M&A class or corporate finance class, they don't know I've written a book of private equity. This book's only coming out on all these book selling sites in the next few weeks. They don't know I've written a book. When I've asked them in the past, how many people want to go into private equity, in a typical class, about half the people raise their hand. So they've been well brainwashed by the business media and the private equity industry, and my compliments to both sectors for doing that. But if I look as a young person thinking of a career, I think private equity is a fine career. I mean, the private equity fund typically has a 10-year life. That's a guaranteed flow of income for young people who are working there. They have little chance of getting laid off because the fund has a guaranteed source of income. And you can't say that about many businesses. You can't say that about many professional athletes. I mean, it's rare for, a top baseball player to get a 10-year no-cut contract. That's what you get in private equity. And if the fund has 2 or 3 sub-funds, so you might have fund 1, 2, and 3, then they've got guaranteed income for the next 15 years, guaranteed fees. And most private equity funds are going to get most of their fees from a fixed fee component, not some kind of performance fee or carried interest is what they call it. So I think it's a great business. It's very interesting. And private equity, I think, is an easier job than, say, the investment banking job. I've worked both sides of the street, and I think investment banking has got longer hours. It's just a tougher haul. And it's also more cyclical. Wall Street will lay off people every 7-8 years. They'll lay off 20 or 30% of the workforce. Whereas in private equity, you got a better job. It pays about the same and it doesn't lay off. So in summary, I think it's a good job. Now, long term, maybe in 15 or 20 years, will the limited partners wake up and say, we've been getting ripped off. They haven't performed so well. Yeah, that's probably going to happen. But in the meantime, it'd be a nice 20-year run for students. And you got to remember that there's always going to be a place for private equity. I mean, maybe the industry won't be as big as it is now in 20 years. But I still think there's a need for it. Investment banking is a fascinating job as well. And I would think it's a good place for a finance student to land if they can get a job. It's very competitive, but some of my students have ended up on Wall Street.
Well, and I think that you've already seen over the last 20 years, fee compression from limited partners creating sidecar funds to invest on a first dollar basis without fees. So they're trying, it appears, to figure out ways to juice their returns a little bit more than just relying on the PE fund to do the things that they do.
Yes, definitely. There's been some fee compression, but there's still a mad scramble to get into these private equity funds. I just think it's unjustified. The fees are a waste of the money of the pensioners or the retirees. That being said, having a complicated investment portfolio with hedge funds, private equity funds, commodities, real estate, and so on, it makes the managers of the state pension fund or the endowment seem as if they're running a very complicated, complex business and they have to be paid accordingly. I mean, if an endowment or a state pension fund were to say something like, well, let's just index the whole thing, what's that say for the job of that manager? They're not needed anymore. So I think a complex institutional portfolio with the allocations we talked about earlier is going to be around for a long time, simply because it's of benefit both to the people that work at the endowment or the pension fund, as well as to the third-party suppliers of investment advice like private equity guys.
It's interesting as you're talking, I don't know if this analogy will resonate with you or not, but I have an investment banking friend whose stepson is on the PGA. And you think about the PGA or Major League Baseball, but PGA in this case, he's a top 150 player in the world. And yet he's having to play on the Corn Ferry the next 3 weekends to get his card back. So you're talking about the top 125 players get guaranteed to go to next year and play in the PGA on all the tournaments out of a million or so many golfers that want to play on the PGA. And it seems like everybody focuses on those top 125. And I think in the private equity world or the young professional world, you want to be that private equity investor who gets articles written about them and has the big home and the yacht or whatever that they have. And it's very sexy and glamorous. And yet there's a whole bunch of people that are trying to get that spot that never do. So it's a lot of luck and a lot of hard work and grinding it out, I would expect, to get to that level.
Well, as a golfer, I can tell you, I've met people that are trying for the PGA Tour. I mean, there, I think it would be more of a meritocracy. In the private equity space, now that there's some of these big established names, it's probably 8 or 10 firms that might control 50 or 60% of the assets. It's not as much as a meritocracy. Like I said earlier, those top 8 or 10 firms don't do better than anybody else, but they now have a brand name that makes it safe for the limited partners who think they have to have some exposure to this to get involved. So it's not quite as cut and dry as, say, a golf pro. You score a much better score. Everybody knows it here in this business that we're talking about. The results are obscure, the fees are hidden, and there's just a lot of misinformation that's spread around that no one seems to be willing to refute. Present company excluded, I guess.
So tell me if I'm one of your students, or maybe I'm working for a bank or a private equity group and I'm early in my career, not necessarily where you think they should go, but what are the steps and things that they should be doing to maybe reach the level that they're trying to reach? What's your opinion there?
If someone's trying to get into the private equity business or say the investment banking business, and I have a lot of students that ask me about it, I mean, the first thing they've got to do if they're in MBA school or taking a master's degree in finance is to hone in on those courses that relate to investment banking or private equity. So that would be mergers and acquisitions or venture capital or project finance. So you can tell the interviewer, yeah, I'm interested in this business and I've taken these 4 or 5 courses that relate specifically to investment banking or private equity. The other thing is a younger person needs to get a little familiar prior to the job interview with the vernacular. EBITDA, EV, M&A. You might say, well, gee, isn't that obvious? But no, it's not obvious to them. So they need to read a few books or listen to some YouTube presentations by people like yourself or people like me. So they kind of get a feel for the vernacular and how it's used. And then, try to set your sights, if you're trying to get a job in the business, on the big name firms, because that looks good on the first resume. I mean, it's hard to get in there, but I think since so few of us last more than 3 or 4 years in a job, once you've worked at a big name firm for 3 or 4 years, it's a lot easier to transfer out than if you work at a small firm and try to, go up to a big one. So that would be my 3 pieces of advice for someone trying to do business. And I don't try to discourage people, but I think they have to be realistic. The private equity field, investment banking field, rely heavily on the top 20 business schools for recruitment. So if you're coming out of a school that's only ranked 30th or 40th, it's an uphill battle.
So do you have any opinions on summer internships, whether a student should look for an internship where they get really deep experience in something with an investment banker or a private equity firm, or is it better to have a big name on your resume? Any feel there?
Well, since an internship only lasts a few months, my view would be just try to get the biggest name you can. That'll impress a lot of people.
It's interesting. I ask that question a lot of senior folks in the industry, and I agree with you that you need to have a resume that stands out and has things that make the person who's looking at it, their eyebrows raise and go, huh, that's interesting, as opposed to, ABC firm that you don't recognize. The other little tip that I give a lot of college students is, if your internship is a summer internship, try to start at least the last week of June and end the first week of August, so you can put 3 months on your resume rather than I worked at Lehman Brothers for the month of July. And it's weird, but that actually psychologically to somebody looking at your resume makes a difference.
I think that's excellent advice. You want to look like you had some staying power at that internship and really did something. I mean, look, you're only there for 3 months. You're very junior. So maybe you were running Excel models or going to meetings and not saying anything, but you did get some exposure. I think it's valuable.
So Jeff, you've written 5 books so far, with this most recent one coming out in a couple of weeks. Tell me about that process. You got to be making millions, right? All these authors make tons of money writing books.
Well, if I were to talk to some young student, I'd say, don't write a book. There's no money in it. So the way the publishing business works, the publisher gets 85% of the revenue. You as the content creator get 15%. So it sounds to me like it's a little lopsided, but I wanted to say something about the business. I wanted to open it up to scrutiny, and having written a few other books, and I've done a lot of pro bono work for taxpayer associations in this area. I just said to hell with it. I know it's a money loser, but I'm going to do it. And I think we've gone far enough and someone has to draw the line. But if you're writing a book, you just got to remember, first, it's tough to get into a publisher to have them publish the book. That's a challenge in and of itself. Writing the book takes a long time. I mean, you could be looking at 9 months or a year. Now, that's not full time, but that's what it's going to take you to do the research, interview people in the business, write the book, rewrite it again, and finally get it polished up where you can submit it to your editor. And then the editor sends it back to you with a bunch of changes. They want you to footnote everything. It's a very arduous process, which I like. And I think it's rewarding for a certain kind of person to do that. And I've met plenty of authors, and some of us march to the beat of a different drummer.
So what do you think your audience is going to be for this particular book? Is it more college professors having it be a mandatory reading for their students, or who's going to be the most attracted to the contents of this book in your mind?
Well, the book doesn't have a lot of numbers in it, Jeff, despite the fact we've been talking about performance and all that. Only 2 or 3 of the chapters cover the numbers and the performance or lack thereof. There's a couple of chapters that describe the leverage buyout business and how deals are done. So like I said, a few chapters on the numbers. And then there's a number of chapters on what I call the enablers, or the fellow travelers, the accountants, the media, regulators, the limited partners themselves that have allowed the myth to go on. So the audience, therefore, is not really a professor type audience. It's not really a textbook, but it's a sort of a book designed for the trade, people that work in the financial services business, be they stockbrokers, investment bankers, or maybe private equity people, or accountants, or lawyers. So that would be one sector that would find the book of appeal. The other sector of customers, as I see it, would be people that have some interest in private equity. Maybe they're not in business themselves directly, but maybe they work in an auto dealership, or maybe they're a doctor, or maybe there's some kind of scientist, but someone that has an interest in business, likes reading books, and thought take a crack at private equity. I've tried to make the book accessible to those kinds of people, so it's not full of jargon and vernacular, and it's got lots of drawings and some photos in it to try to illustrate concepts which are sometimes a little confused to people, but I think it's very accessible to an average reader.
I would assume somebody who's written 5 books and they're a professor and they've been in all the various seats that you've been in, you've either got some quote or motto or something that drives you every day to do what you do. Somebody like you who's written 5 books has to have some sort of a passionate thing that drives you to do that even. So do you have anything like that you can share with the audience?
Particularly the younger ones need to realize that the careers that they're going to have are not going to be linear. They're not going to get steady upward movement where they get promotions every 2 or 3 years. There are going to be some ups and downs. And so one thing I've tried to do, which was instilled in me by a couple of older friends, is try to be productive. Try to be productive when things are going sideways or south. Don't give up. Just try to be productive, maybe some other thing. So I remember there was a slow period in my career. And so I said, well, I got some free time. What am I going to do with it? I didn't want to play golf all day or practice the piano. So I thought I'd write a book. I always read a lot of books, so I thought I'd try and write one, which I did. I sold a bunch of copies. And so I might be a more restless individual than some of your listeners, but I think as they get a little older and encounter the ups and downs of careers, they just got to keep that in mind, try to be productive in some other way.
Well, you mentioned restless. It's interesting because a lot of my guests mention the word curious, and grinder or restless would be a similar word. And I'm reading a book right now called The Obstacle is the Way. And I think what you just described fits that chapter that I was just reading last night, actually. Pretty interesting timing, just how sometimes obstacles, and it could be a slow time in your career, it could be something that is keeping you from going where you want to go, having the ability to change paths and take advantage of the obstacle or run to the obstacle, which you decided to write a book as opposed to just sitting around waiting for whatever to get over, can be a really good strategy. Something a lot of young people are a little bit afraid to run towards the obstacle. They'd rather run away from it.
It takes some maturity on their part to do that, but they have to acknowledge these facts, like your book suggested, when something goes sideways. So hopefully for most of them that won't happen, but my experience in the finance business is that there are cyclical elements to it, and they will see some bumps along the road as they get older.
So I know some of my audience who listens to a lot of the podcasts know that my parents were both teachers, very successful teachers, and love everything about education. I'm curious, what's been some of the most rewarding things that you've had from teaching the students that you get to work with?
The most rewarding thing about teaching is you're around young people, so you don't feel old. A fresh perspective on things, which, older people, I wouldn't put you in that category, but certainly me. I mean, we lack that, kind of do the same things, we think in the same way. Whereas if you're in a classroom with a lot of younger people, you'll see some fresh perspectives. The other thing from a strictly intellectual bent is, even though I think I know everything about finance or M&A or private equity or something, if you're teaching it, even if you've taught it for several years, there will always be a few questions that you hadn't thought of. He has a different take on it than I would have ever suspected, or she does. And so it makes you look at the field in a slightly different manner. And it actually expands your knowledge because you have to think about answering that kind of question, which you never confronted before. So you have the benefit of being around younger people. You also have the benefit of looking at your own profession from a variety of angles that perhaps you wouldn't have considered without being in a classroom.
Before the podcast started recording, you talked about some of your classes have a good number of foreign students. I'm curious, is there a lot of difference between the traditional American student and a foreign student in how they approach class, how they approach their work, questions that they might ask? That might be a spot where you get these questions that you'd never thought of before. Any thoughts there?
Well, the questions that come out of left field that you wouldn't expect come from all students, American and foreign. I mean, it's generalized a little bit, but the foreign students tend to be a little quieter and a little more respectful of the professor than, say, an American student. And that's just the tradition in a lot of foreign countries. Whereas American students, it's something they learn in high school and even undergraduate school. They're a little more willing to participate in class and question the professor and, perhaps provide a counterpoint, which I think it's constructive. It lends a little bit extra to the class.
Yeah, I bet that's an interesting dynamic. And to your point, if I was in another country, I'd not only be more quiet just because I'm trying to be respectful, but I'm not sure of the dynamic of when you're supposed to talk. And I may not even understand the topic as much as somebody who speaks the local language.
It's interesting you mentioned that, Jeff, because the reticence to talk with a foreign student, in my experience, it tends to dissipate after they know you for 5 or 6 weeks. So 5 or 6 weeks go by, they see that you're not going to bite their head off if they ask a question. So that dissipates after a while. But I think they seem to repeat that in classes for the first 5 or 6 weeks, and then it kind of goes away. It's just something that's traditional in lots of cultures that students in America, which I'm sure include a lot of your audience, aren't used to.
That's such a good point with the students. And everybody's had a teacher that you ask a dumb question and you get undressed in front of the rest of the class. And that's the last question you ask for the rest of the semester. And I mentioned earlier, I looked you up on Rate My Teacher. There were a lot of good comments that you were a fair, nice teacher. It looked like you were also a tough grader, which is awesome. And somebody even mentioned it was almost like you didn't get participation grades, which I love because, not everybody needs a trophy, right? So I like you were the type of teacher that would challenge your students, but be very fair with them and nice, which really creates a great classroom environment. Jeff, I really appreciated our discussion today. I was going in a little bit with trepidation that might be this discussion that after this, all my podcast listeners are like, wait, I'm out. Why is he interviewing this guy that is basically discounting everything that we do in the private equity world? But it's a reality of the facts that you've been able to accumulate. And I think it'll be an interesting read for a lot of our listeners to dive in and potentially challenge themselves to figure out ways to be in that top quartile.
Just have them reflect upon the fact that the conventional wisdom on Wall Street is upended about every 10 or 12 years. So we have a crash on a regular basis, be it 1999, 2000, when the air went out of the internet balloon. Then you have the crash in 2008, 2009, when real estate values plummeted and there was all the controversy over bank failures and because of real estate loans. And I don't know what the next one's going to be, but I've been in the business for close to 40 years, and there's been several of them. And so they have to be brave enough to question the conventional wisdom from time to time. That's probably one of the main takeaways of this book, Myth of Private Equity, is don't be afraid to challenge the conventional wisdom from time to time.
Oh, I love that. I think that's a great way to end. I really appreciate you joining us today, and good luck with the book launch, and look forward to staying in touch.
My pleasure, Jeff. Thanks again.